My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends? Just trying to make you a little money. My job is not just to entertain, but to teach you about how the markets work. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Here's something no one's willing to do. No one. I'm going to call a bottom. All right, it doesn't matter that it sure looks like we have one in the middle of June when oil spiked to the mid-120s. The 10-year Treasury yielded 3.5%, and the future looked very bleak.
The House of Pain.
That's when the averages hit their lows, and since then, they've made a remarkable recovery. So it's a little weird that we don't hear more about the bottom being called, especially on days like today where minuscule moves in bonds and oil cause big swings in stocks. Even as the Dow ultimately finished up only 60 points, S&P advanced 0.29%, NASDAQ gained 0.41%, though. How come nobody wants to mention that we may have been, maybe we got a bottom? Why don't they? See, I got to thinking about this after listening to some excellent work from my colleague Michael Santoli when I sat down with Scott Wapner on his halftime show today. Michael was pointing out the potential importance of those June benchmarks I just mentioned. I found myself musing on one of the biggest changes in this business over the past, let's say, 3 decades that I've been involved in, about for 4, but 3 decades ago is where it really started. See, no one wants to stick their neck out anymore. No one wants to say that was the bottom and we're in the clear, even when we've already bounced hard from that bottom. You know why? I think YouTube plays a brutal role in this dynamic. If you call a bottom on television, it's a mistake. Maybe we get some black swan disaster or horrendous third-quarter earnings in October or a crazy election scenario. Then you will forever be known as a fool because those clips never go away. That's why commentators really don't have much incentive to try to call a bottom. If they're right, they don't get much credit. But if they're wrong, well, let's just say they will never, ever live it down. That's way too asymmetrical for too many people. They'll always be known as the dope and called a false bottom. They will deface your tombstone with it. Now, I'm willing to take that risk in part because I know a big chunk of people who will hate me no matter what, but mainly because I like where we are right now. While I think we could test June's lows, I mean, even tonight we had weak numbers from Salesforce.com, and they were weak, and weak numbers from NVIDIA, and they were weak. There's plenty of reason to be apprehensive, but I'm betting the market will bend, not break, through a rough September, and when we get through that period, that June low will hold. Now, it won't be easy because we got a bunch of new negative factors. But I want to stake my claim today ahead of the Jackson Hole speeches from Fed Chief Jay Powell and his central banker compadres on Friday. Why? Well, remember the context. In mid-June, we had just gotten a triple rate hike that week on June 15th. And that's a pretty staggering move by the Fed. And it shows that the Fed meant business. Now, historically, we don't get a lot of 75 basis point bumps. Wall Street lapped it up, though, because it told us the Fed's taking inflation really seriously. But then the next day, there was tremendous buyer's remorse in the stock market. Investors seemed to assume that things were still very much out of control. Okay? They figured we'd get hit with a series of additional rate hikes, aggressive ones, and therefore we had to steel ourselves for some real discouraging earnings reports come July. Why not, right? I mean, it makes a lot of sense. Fed tightening, and we're going to go into a gloomy period. The reports are going to be bad. The sell-off was nasty to the point where it brought down virtually everything. That's one of the reasons why I'm so confident that these June lows that we're talking about right here might actually represent a bottom, because so many people capitulated and so many hedge funds got short. Let me put it in perspective. First, we tend to look at stocks in a vacuum. We want to know how the S&P 500 is faring and how our individual stocks or mutual funds are doing. But we rarely look around at other asset classes, which is why investors often make big mistakes, like dumping stocks in the lows in June when we got that first 75 basis point rate hike instead of buying them. If you only looked at the stock market, you would have missed what caused the bottom. While stock owners were skeptical about the impact of that rate hike, bondholders and commodity traders had a very different reaction. They decided that Jay Powell was no longer to be trifled with. People bought 10-year treasuries hand over fist, so the yields started coming down. At the same time, oil prices spiked, and they rolled over. I mean, it's rather amazing. Here you have the first spike, and then the second spike, and then oil rolled over, even though it was in the 120s. Given how important the price of crude is to the inflation food chain, including day-to-day inflation that's right in your face at the pump, we should have realized that this was a monumental story. We never heard the end of it when oil was on its way up. Somehow it became a non-issue on the way down. That was wrong. Bond market knew that. Okay, so you have to ask yourself, how did so many investors miss this? You see, because the decline in oil had nothing to do with the United States or even the well-covered OPEC. It was all about Russia striking gold with India. We thought Russia wouldn't be able to find markets for its sanctioned oil outside of China. That would have bottled that oil up. Oil would have gone, of course, through the roof. But India couldn't resist that cheap crude. That meant the world price had to come down, and it collapsed. Bond guys, sensing a peak in the most important commercial commodity, just kept buying bonds and buying bonds, causing the selling in stocks to stop because the bond market is joined at the hip with the stock market. How about the worries of the stock market investors that the second quarter numbers would be terrible and the guidance would be worse? Because that's what normally happens when the Fed tightens like crazy. Well, you know what? It hasn't happened yet. It didn't happen. This earnings season, the one that just ended, vast majority of companies did fine. A huge number of beat and raised quarters. Very few true disappointments, with the exception of some software companies that forecasted too high and got hurt particularly by the strong dollar, but also by customers who were nervous, and most importantly, retailers that misjudged everything about the consumer and have way too much inventory. Since the June lows, nothing has happened that would shatter the illusion or reality of a bottom. Oil crashed, with prices plunging from the 120s to the mid-90s. That's a stunning decline, one that devastated the oil stocks while creating a nice rally in a lot of techs because they tend to trade in opposite direction. Now we've had a bounce in the basics, the grains and the metals of late. But these are the normal commodities. Got to be careful. We also had a modest spike in oil, but the latter wasn't enough to offset what came out today, which is a decline in home prices for the first time in 3 years and the largest month-over-month decline since 2011. Without something out of Russia that limits oil production, some sort of U.S.-led embargo, highly unlikely, then oil simply not going back to those threatening levels. Why does this matter? Without a spike in oil, which would cause a collapse in corporate earnings, then I think the June lows will hold. Notice, I didn't say they should hold. I said they will hold. The trial will come when the Fed starts selling its own bond holdings with reckless abandon as they keep raising rates. That could create a test of the lows in September. But again, I'm confident that they'll hold. You see, there are so many things that are actually going right in the United States that it's hard to import the bad stuff from overseas. Our natural gas costs are a tenth of what it costs in Europe right now because we have more of the stuff virtually than anyone on Earth. Our natural resources cup runneth over, even if we're despoiling the planet pretty faster than ever. We don't have an economy that's collapsing under the weight of endless COVID restrictions like China. We don't have a war down the block that's been raging for 6 months, even though only Russia and Ukraine are going at it directly. The reverberations are hurting anyone who sells goods or services in Europe. The bottom line, we have much to be grateful for in the United States, including that glorious June 16 bottom. And I, for one, am a believer. I don't mind making that call and running the risk of still one more YouTube presentation that's cut to make me look like a moron. Haters, knock yourselves out. Let's go to Neil in New York, please. Neil.
Hi, Jim.
Hi, Neil. What's up?
I'm calling about the 3M spinoff, which is complicated. The offering is to exchange any amount of your 3M stock at $100 to get $107.50 of 3M spinoff Garden Spinco Corp. Following the transaction, you're going to get the value of Neogen shares. You can't sell the Garden Spinco shares at a profit, and you have to take the Neogen shares when they convert. And
and that's why I've got to tell you, Neil. But that's why I think that it's worth selling 3M. I just don't think that there's enough there, whether it be the yield or earnings, to really make it so that it's worth owning. Let's go to Michelle in New Hampshire, please. Michelle. Michelle?
Yes. Good evening.
Hi, it's Jim. How are you? Yes, how are
you?
you?
I'm good. If I could tap your wisdom this evening.
Sure.
Okay, great. We benefited when United Rentals recently appreciated a bump after reporting earnings. So my question to you is this a time for profit taking, for long-term investment, or for something in between? So that's
I think, look, it's a great question, Michelle, and I've got to tell you that I think they're going to be a principal beneficiary of all this infrastructure spending, and so therefore I want you to hold on to URI. Almost no one in this business is willing to call a bottom, but I'm willing to stand by that glorious bottom in the middle of June. I think it will hold and bend but not break. On Mad Money tonight, Salesforce reported after the bell, so what could be gleaned from the Cloud Kings quarter? I've got the exclusive from the CEO. Then, as you set up your fantasy football lineup, we're putting a classic Mad Money twist on fantasy and giving you a lineup of stocks that might be worth watching. And did Snowflake's report bring the blizzard to Wall Street that tech investors were worried about or hoping for? I'm running through the numbers with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.